In today's video, I will be going over 3 stocks that I bought today and 1 stock that I sold. What is up, guys? How's everyone doing? So, I'm just making a shorter video today because I actually did a decent amount of I made a decent amount of changes in my portfolio. So, I normally, since I'm just investing for the long term, will maybe buy 1 or 2 stocks every month, and every few months maybe I'll reduce my position in a stock, but I'm really not trading frequently. But today I actually added into my positions on 2 stocks and then bought 1 stock and significantly reduced my position in another stock. So I figured I would just make a video. I'm not going to do any super in-depth analysis on these companies, but more just letting you guys know what I did today. Of course, if you guys would like more in-depth analysis on any of these companies, just drop a comment below and I'll be happy to make a video on that. So we'll start off ConocoPhillips. I sold 45 shares of ConocoPhillips. That leaves me with about 20. I think it's like 20.6 because dividend reinvestment. And so I know Conoco's trading right near support levels and has fallen pretty recently from 50 down to 44, but I just have too big of a position in Conoco for the size of my portfolio. I should not have as much money invested in Conoco as I do, so I'm not closing my position. I'm just reducing it by about 55 or 60%, and it will still be a similar size as a lot of the other positions in my portfolio. So I have Exxon as well. And I have Phillips 66, which is a refiner, so kind of separate. But I just think I had too much money in oil stocks and was kind of too dependent on oil prices, and I want to separate my portfolio from that. So that is why I sold off some Conoco. They have a 2.3% yield, which is decent, not great. I moved into Verizon and AT&T, which both have 5% yields, so I'm definitely more happy with their yield than Conoco, and I see both of them as being more stable than Conoco. I think Conoco is still too dependent on oil prices, and their price moves it moves a lot with the price of oil. So I will now just move into Verizon, the first stock I bought. They have been down from 55. They're down now, trading at 44.60 per share. And so I am long Verizon from a while ago. I think I bought sometime back in 2014, I think. So somewhere around here, maybe in the $47, $48 per share range. And I've been holding it since then. So I've been watching it, and I think that currently it is an attractive buy to add to my position. So here's Verizon on Morningstar. As you can see, they have a 4.97% yield, which is really nice. 5% yield is great. I'll be reinvesting my dividends, of course. And so pretty much the S&P averages about 7% per year in gains. So with a company paying a 5% yield, if the company only goes up 3% per year and maintains their yield steady at 5%, then that's going to be outperforming the S&P 500 on average. And so I really am attracted to that 5% yield. So the main concern with Verizon is their high debt load. So pretty much Verizon has been using debt to finance a lot of acquisitions and other things recently. And their cash flow for 2017 actually dropped into the negative. So people were thinking, oh, is Verizon taking out debt to pay their dividend, which I actually don't think that they are. I think that what happened is, so you do remember a few years ago where when you would get a cell phone, your provider would oftentimes pay for that cell phone, and then as long as you signed a contract. Well, now that's not really happening. So what people are doing is they're paying off their phone in monthly payments pretty much to Verizon, as well as their cell phone bill. And so Verizon used to be taking the debt owed to them from customers on the payment plans of cell phones and selling it bundled to banks, and that was giving them cash, which then was used to calculate their free cash flow. But instead, what Verizon is doing now is holding on to those payment plans and then selling and then taking on debt against that, which gives them a good way to take on debt if they need it, which I think they already have a lot of debt. So I'm hoping they'll be reducing their debt, which they have been slightly over the last few years. And then additionally, this has pretty much just made their receivables go up, but it hasn't. But it has affected their cash position, which has affected their free cash flow, and so it makes it seem like it is negative. But in reality, I think that they're still generating enough money to pay their 5% dividend without taking on debt just to pay the dividend. So I think that their dividend is safe. I think that with a price to earnings of 15 and a forward price to earnings of 12.1, that they are an attractive stock. So I upped my position. I think I'm just adding. I just added about 10 shares of Verizon because I already had 10 or 12. So not a huge addition, just another $460 into that company. So now moving on is Shire Pharmaceuticals. So I actually recommended this stock in my most recent 4 stocks to buy in June video. And I'll link that video in the description in case anyone wants to check that out. But as you can see, they are down since then, and I think that this actually presents an attractive buying opportunity. I know that they fell like 4% in one day because one analyst downgraded Shire Pharmaceuticals, and I personally don't really listen to analysts that much. I think that I could potentially make a video on why I'm not a huge fan of listening to analysts, if you guys would be interested in hearing more on that. But pretty much I think that they raise their price target on stocks as the stock is going up, and then that leads to people buying the stock at a high price, and then as the stock is going down, they just continually lower their price target for the stock and rate it a sell, and that just leads to buy high, sell low, which is the opposite of what you want to be doing. So as you can see with Shire, they when I recommended them, they were kind of trading near a trend line up here that would push them down, and I'm not really big into entering my first or starting my first set of buying into a company based off of technicals because you never know what's going to happen. And so I just I bought 2 shares of them initially, just a small position, and now they bounced off of this top trend line and they're trading down near a bottom trend line, which will theoretically send them back up. If not, there's still support down in the 160s for them, as well as support down at 170 if they were to break through this trend line. So I think that they're pretty safe at the level that they're at right now. And so I'm adding 3 shares of Shire Pharmaceuticals today. They have like a 0.5% dividend, so it's not really a dividend play, but more a play because I think that they are going to have good growth in the future, especially with their new HAE drug. And so I'm a fan of Shire Pharmaceuticals. I think that they are trading at a good value right now with a forward price to earnings of 9.5, a price to book of 1.8, which is pretty rare on a pharmaceutical company that you see a price to book of 1.8, and then a price to sales of 3.7, which is pretty nice. If you look down here, they have low debt, and they're just a solid company overall. So then moving on to the third stock that I added today, it's AT&T. And so AT&T I added for similar reasons to Verizon. I think that AT&T is slightly safer than Verizon. I think that, well, I'm not nervous about Verizon's debt load. It does add some risk to Verizon because if there were a random one-time event that cost Verizon a significant amount of capital, that could be dangerous because they have the high debt load. So I'm adding 25 shares of AT&T at current prices. I think that it was up at about $43 per share and is now down trading at $38.50. AT&T also has a high dividend similar to Verizon, 5% yield, which is always great to see. I love dividends. And they have a forward price to earnings of 13, price to book of 1.9. And I think that they are another good company. Their price to earnings is slightly higher than Verizon, but this is okay because they have a lot lower debt than Verizon. Debt to equity is only 1 on AT&T, which is definitely not risky at all. The margins for AT&T are lower than Verizon, 7.8 versus Verizon having a 10% net margin. So I think that I do prefer Verizon slightly to AT&T, but I think Verizon is slightly more risky than AT&T. And I didn't have any AT&T, so this is a new position for me, first time buying into AT&T. And I think that they are poised to do well in the future. I'm a fan of both AT&T and Verizon as stocks, so I think that the telecom sector in general is also going to perform well, though I'm not buying a telecom ETF because I would rather just buy AT&T and Verizon and not have to deal with some of those smaller telecom producers that I really don't know a lot about. And I also, the dividend on a telecom ETF is lower than on Verizon and AT&T because Verizon and AT&T make up two huge dividend payers in that ETF, and a lot of the smaller telecom companies don't have as big of dividends as AT&T and Verizon. So those are the three stocks that I bought today and the one that I sold. I hope you enjoyed this video. Like I said, if you guys want any more in-depth analysis on any of these companies or any company that you are interested in, just let me know in the comments. I'll be happy to make a video for you. Thank you for watching. Remember to please like and subscribe.